As a breakout trader, you should know when to enter trades, but you should also know when not to enter any breakout setups. So today I'll show you exactly when you should not trade breakouts, going from overall market conditions to very stock specific criteria. Let's get right into it. All right, so first one is going to be aiming beginners a bit more, but it starts with the S&P 500. So for this criteria, you should use moving averages. Personally, I use simple moving averages, the 200, which is the green line, the 50, which is the red line, the 20, which is the blue line, and the 10, which is the purple line. So using these, if you're a beginner and you want to maximize your win rate while still protecting your capital, you should not trade any breakouts when the 10 moving average is under the 20 moving average on the S&P 500. So what I'm saying here is that, for example, if we go through here, as you can see, the purple line is under the blue one, so you should not trade any breakouts. Fast forward a couple days now, so the purple line is above the blue line and you can start trading breakouts again. It really is as simple as this. And the reason why is that moving averages are an average of the price of the current stock. In that case will be in the ETF over a certain period of time. So the 10 is over a 10 day, for example. So that being said, when the 10 moving average is above the 20 moving average, it means that the shorter term trend, the 10 day in that case, is stronger than the longer term trend, the 20 day in that case. So usually, as a rule of thumb, your breakouts should have better follow through, but it's not always the case. So that's why I'm saying this is more of a beginner's rule. If you're more of an experienced or advanced trader, this is a rule you can adapt based on your trading style. But you can also do to adapt if you want to still trade when the 10 moving average is under the 20 moving average, you can just decrease your risk in your trading positions. Another really simple rule using moving averages when trading breakout is that you should not trade breakouts when your setup is under the 200 moving average. So in that case, you can see here it's a tightening flag, but it's under the 200 moving average, which is the green line right here. It breaks out right here, pretty good breakout, higher volume, but it bounced on the 200 moving average and it goes back, way lower right here. Once again, the reason behind this is that the shorter term trend using these moving averages is weaker than the longer term trend, the 200 moving average in that case. It is not always like this, but as a rule of thumb, your setup or stock is weaker and then the follow through usually is weaker as well. What I personally like to do when I see this is, for example, let's say I'm looking at this, it is breaking out, I'm skipping the position because it is under the 200 moving average, but let's say it just keeps going up, right? Well, what I'm usually doing is I just keep an eye on this stock, maybe I put it in my watch list, my focus list, whatever it is, and then, if it follows through, eventually start setting up again, provide us with another tightening flag, whatever setup you want to trade. Well, then now if it sets up again above the 200 moving average and then recently had some decent follow through above these, the 200 moving average, above all moving averages in that case, well, I'd be interested in entering this if it were to break out again. So I would be interested right here if it were to break out. Another rule you should follow about when not to trade breakouts is regarding volume. All right, so as you can see right here, it's a pretty good looking setup. It's above the 200 moving average, pretty good higher lows, pretty good lower highs. But if you're looking at the breakout day right here, the volume, if you zoom in, the volume in the breakout day is actually under average. So the average daily volume is what you should use, and it is shown by the blue line above these volume patterns, volume columns right here. So as you can see, the breakout day volume is under the average daily volume, but it also is at the end of the day. So this is the volume, the full day volume. But usually when you enter trades, when you enter breakouts, you're looking about these, maybe a couple minutes after market open. So how can you see what the volume would look like if the volume will be above average in that given day, just looking at the first 5 or 10 minutes, whatever it is? Well, it's actually really simple. So let's look at this example. So we saw that during the breakout day, the volume is actually much lower than the average daily volume. And if you have the eye, you might have saw that the previous day, the day right before the breakout day, actually was right at the average daily volume. And let's say you trade exactly like me, you entered the first 5-minute candle high. Right now we're on the 5-minute time frame, and your first 5-minute candle high is right here at 41.47. So technically, all other criteria apart, you would have entered on the second 5-minute candle. But you also have to look at your volume, and you can see that right here the volume doesn't tell you much about the average daily volume, right? It's the 5-minute time frame. But what you can do is, knowing that yesterday, so this day right here, was right at average daily volume, you can look at how it was doing the first couple of minutes right after market open. But as you can see, the first couple of minutes on the breakout day were actually lower than the day before that. So you can already tell yourself that it might be a lower volume day. Now, I can understand that sometimes the volume picks up much later during the day, which in that case, you can see right here, it is. It picked up right the middle of the day and then at the end of the day. And it also did the exact same thing on the breakout day. But as a rule of thumb, if you're entering off these first couple of minutes after market open, look for the volume after market open. If a breakout is going to be very strong, going to have a lot of momentum, usually the first couple of candles after market open are also going to have a lot of volume. Let me show you an example. All right, so looking at this RGTI, this is a position I traded a couple of months ago. You can see that right here, it's building a good range, great lower highs and even stronger higher lows supported by the 50 moving average. It's above all moving averages as well. It even actually started to break out right here, but the volume was just at average daily volume. And as you can see, the following day, it is clearly opening above that range, clearly breaking out on higher volume. It is clearly above the higher trend line as well. So let's look at the intraday chart. So 5-minute time frame, you look at, all right, this is your breakout day, and this is yesterday, which we saw that the volume was just at average daily volume. So looking at these first couple of minutes, you can see that, right, well, yesterday, if this is around average, it's been like that all day. And then here, the first couple of minutes, you can see that it is much higher already. So you can already tell yourself that, okay, this is probably going to be a much higher volume day. And even if it's not insanely higher, you can already see that it's at least going to be above average, right? And looking at how I'm personally trading, entry would have been right here at the first 5-minute candle high, stop loss would be at the low of the day. And then as soon as this broke out, look at the volume on the bottom right here on the third one. It was already much above average. And looking at the day before, which was right at average daily volume, there's not a single candle that was around that 5-minute candle volume. And as a matter of fact, the follow through speaks for itself. Look at this, just keeps going up, and here it sets up again, and next thing you see, it's breaking out again on higher volume, and then the follow through is better. So overall, this was a 200% gainer for me. At peak, it was 230%. When I exit the position, it was 170, around 175. Off the full position, but I also added to my position right here on the smaller breakout. And at peak, this was 85% add and then 55% right at close. So you can tell a lot by the follow through by just looking at the breakout day volume. So these are my top 3 rules, but I'll give you a 4th one just to make sure that you're fully ready and fully aware of what can happen in the market. So as you can see right here, it's a pretty good looking position. It's a very strong name. Huge volume on the breakout here. I suppose it was probably earnings or some catalyst driven moves, and then you see it's making good higher lows and somewhat okay lower highs. Next thing you see, it is breaking out right here. Obviously it was not a gap, but it was still breaking out midday. And if we were looking at this, the volume was actually above these past couple of days. It was around average, but the average was driven up by this huge volume day. So it actually was not that terrible of a volume. So I totally saw this move live, but I decided to skip it. Can you guess why? The real reason is because it is a biotech. So even if it was the best setup I've seen in my entire life, but it was a biotech, I would have skipped this. Let me tell you why. So a biotech company is basically a company with no revenue that makes research for a specific drug. Since it doesn't have any or much revenue, it funds the majority of their projects through the investors' money. And biotech companies are basically only waiting on one thing: FDA approval for their drugs. So if their drug or project is approved, you'll obviously see major spikes in volume, huge price surge. But if it's not, it can drop insanely fast overnight. And it's exactly what happened here. So in that case, the breakout is not bad. There's some small follow through. And look at this. Out of nowhere, it gaps down 65%, which is way under your stop loss, and you lose way more money than you risk. As simple or dumb as it might seem, I personally never trade biotechs for these reasons. And if you're a breakout or swing trader that does not particularly specify in these biotech stocks, I recommend you don't as well. So that being said, the best traders don't trade more. They filter better, and they're not scared of just skipping any position that doesn't fully fit their criteria. I truly hope this video helps you. If you have any questions, let me know in the comments, or you can also come ask me directly in the Discord. The link will be in the description. If you want more of these videos, don't forget to like and subscribe. But as always, lock in, stay disciplined, and I'll see you in the next one.